Investors Chronicle.
Welcome back to the Companies and Markets Show. It is the 1st of September 2022 as we record. That's for us, not for you, listener. And Dan Jones is joined in the studio on this episode by Alex Hamer, Alex Newman, Michael Fahy and Mark Robinson as well. All that to come, but first, a quick roundup of the news this week. Yet another sector under pressure. On Tuesday, the British Beer and Pub Association and the heads of 6 breweries and pub companies penned an open letter to the Prime Minister seeking targeted support. It comes with some companies facing energy bills which are more than 300% up on pre-COVID levels. Speaking of energy bills, the grassroots movement Don't Pay is continuing to gather momentum. The group are urging consumers to go on strike over rising energy bills and have added 130,000 supporters since mid-June. The group is hoping to amass 1 million supporters who will cancel their direct debit payments to energy companies en masse on October the 1st. More bad news for Cineworld. As reported by the Financial Times, the company made an error with the disclosure of its biggest shareholder in its annual report for the year to the 31st December 2021. This comes after the cinema giant confirmed that it is exploring a bankruptcy filing, as it looks to restructure while weighed down by a huge pile of debt. Elsewhere, US officials have told chip maker Nvidia to stop selling to 2 Chinese companies. The chips in question are designed for artificial intelligence work. China have condemned the move as Washington steps up efforts to restrict the sharing of cutting-edge technology with its trade and military rivals. And staying in China, internet titan Tencent is pivoting from years of aggressive buying to now focus on selling. The company has outlined a soft target of divesting about $15 billion of its $88 billion listed portfolio this year, according to FT sources. And finally, the chief executive of Reckitt Benckiser, Laxman Narasimhan, will leave the business at the end of September. Over to Dan with the rest of the show.
Thanks, John. Yes, we have another action-packed schedule today. We are first going to be looking at Braemar and a little discussion of shipping and freight rates and everything to do with that. And then we are looking at our cover story, which is about the oil majors, Shell and BP, what the future might hold, the medium term as well as the near term, which might be quite predictable to people. And then finally, we are going to be looking at the pound, which has had another pretty dismal time of it over the past few weeks. We're going to be looking at the reasons why and the implications for certain companies and what investors can take away from that fall. But let's start with shipping. With me, Mark Robinson has covered Braemar's results. The AIM company, a little unheralded compared with its larger peer Clarkson, but the results themselves were fairly positive after a delay in putting out those numbers, and the company itself is still pretty bullish, Mark.
Yeah, it was a fairly lengthy delay as well, given that their year end is the 28th of February too. But it was all linked to an acquisition of a German company a while back, and the sort of consequent analysis that looked at the way that they'd treated reserves on the balance sheet. But leaving that aside, it was some cause of consternation actually. But leaving that aside, all the metrics were positive. Revenue from continuing operations was up by about 1/5, and underlying profit by 1/3. The market was cheered as well because the chairman Nigel Payne said that expectations for the current financial year are well ahead of the board's previous expectations. So it was little wonder that the shares increased as they did on results day.
Yeah, I think that's particularly interesting. I mean, obviously everyone's concerned about the outlook right now, but that is coming at a time when freight rates have actually been, dropping quite significantly in recent months. But it's fair to say, the company's it's not just keyed into, the path of those rates. It has more strings to its bow than just the price of shipping itself.
Yeah, without a doubt. Nigel Payne said that the global shipbroking industry the conditions are pretty favourable at the moment, and he cited some headwinds like exchange rate volatility and inflationary effects. We all know about those. He also pointed out that the conflict in Ukraine wasn't going to have any material effect on trading or cash flows. I guess it's true that spot rates for containers leaving the major Chinese ports, Shanghai, they've pulled back a bit, and it's partly the result of consumer spending habits, where they've shifted really from goods to services. But they remain elevated. They certainly remain elevated on an historical basis too. So that's important for investors to keep in mind, and also the fact that if you're looking at the sector, it's essentially a long-term growth story, but particularly in emerging and developing economies. And so, if you were including that within your portfolio as well, it's looking well beyond the horizon on that, and it's that familiar story about a sort of a developing middle class in emerging and developing economies. So you're going to have a lot of one area that will sort of expand steadily over the years is in global dry bulk, because demand for those kind of products, whether it be iron ore, wheat, sugar, or cement, that's always going to rise as middle classes expand in the developing and frontier economies too.
You mentioned Ukraine there, and I'm just going to bring in Mike, our deputy news editor, who's written about shipping in the past, because that has had an impact for the better for shipbrokers in terms of liquid natural gas and obviously the inevitable increased appetite for that, and for getting some of these for increasing trade there. Is that fair to say, Mike?
Yeah, I think so. And when you look at Braemar, quite a bit of what it does is shipbroking. It's getting cargoes onto ships. So when you have people around the world scrambling to get gas of any kind from Asia, from Qatar, from Algeria, from wherever, they have to get that onto vessels somewhere. And the LNG ships went from being underutilized certainly 2 or 3 years ago to in the last couple of years, rates there have rocketed up. So, and if people are really scrambling to get LNG shipped from one place to another, then a lot of these LNG cargo ships are fully booked out, or are certainly booked months in advance. And in a similar way, where we've had this big run up in container rates, even though that's softening now, it then sort of spurs the next wave of investment. It spurs people ordering more container vessels, more LNG vessels. The shipyards in South Korea suddenly get very busy again. And it's some of the work around that, the financing, the deals to buy them, that's where Braemar also makes some of its money as well.
Yeah, I think Braemar also mentioned that, to your point there, that capacity at many shipyards is unavailable well into 2025. So that's had a beneficial an effect on their sale and purchase desk, and presumably that's going to accelerate in the future as that capacity is driven up.
Yeah, I think on containers particularly, the spot rates are now falling, but it's still the average rates for the year, because they're based on the rates that people signed maybe a year ago, are still holding up reasonably well. You've got some of the big container lines expecting to make record profits this year. Maersk have upgraded their guidance 3 times so far this year. Hapag-Lloyd are expecting to make something like 18 billion euros. So there's still, for now, some strong growth expected in that market, even though it will start to fall away next year. And one of the reasons why it'll start to fall away is because of the massive number of new ships that have been ordered, which again is a plus for Braemar.
Well, one thing Clarkson said in its results the other week was quite interesting, just talking about some regulations coming in, as with many sectors now, ESG, sustainable kind of focused regulations, which it says will have the effect of, slowing ships down because emissions reductions increasing dry dock time due to energy efficiency, that kind of thing. I mean, obviously it's in Clarkson's interest to say these things are good for us, but that's something to watch as well, I suppose, from next year.
Yeah, there was a change, I think it was about 2 years ago, in the amount of sulphur that could be emitted through shipping fuel. And that's leading to quite a lot of retrofits and also just orders of new, more fuel-efficient vehicles capable of running on other types of fuel.
I suppose for shipbrokers, is there much impact from the way that trade routes are changing as well? You've seen quite a lot of shifts in the US from West Coast to East Coast, partly due to congestion, also due to some labour disputes over there too. I mean,
no, I don't think so in terms of the routes themselves, because in general, the container vessels making those routes are the kind of most modern post-Panamax huge ships that are capable of doing journeys around the world where they need to. So I don't think that in itself has much of a difference. The only kind of factor and the only reason really why people have shifted from West Coast to East Coast was that huge sort of backup of vessels off the port of Long Beach in Los Angeles, and I think mid last year there was something like 100 ships waiting outside that port. It was down to, I think I read somewhere, something like 8. So we're really down to levels where that congestion is cleared, and so you would expect maybe a bit of a reversal of that trade as well from East to West Coast.
Yeah, we'll be keeping an eye on that. Braemar itself is quite interesting. It has traded at a discount to Clarkson historically. It's got a bit of a turnaround plan now. We'll see what happens there. It's also quite interesting, just when I was looking at its shareholder register, it's one of those companies, it's quite a big retail following, but almost no institutions at all, which is, a plus or a minus, depending on how you view it, but certainly potentially some scope for interesting things there. Let's move on, though, to our cover story this week. Looking at energy, looking at the oil majors. Obviously, these are topics at the forefront of all of our lives at the moment, but we're really looking at Shell and BP in particular, obviously from a UK context, as we do. Alex Hamer, our news editor, is here. Alex, you wrote the piece. Why don't you just explain sort of the outline, the thinking behind it to begin with?
Yeah, I'll just repeat my pitch to you a few weeks ago,
Sure.
Dan. But it's such an interesting time in energy markets. It's also a very distressing time and difficult time for people on the receiving end of these prices. But we, over the past few years, have taken a fairly critical view of Shell and BP as these behemoths that highly indebted, they're trying to be all things to all people with these big transition plans. Shell made a lot of promises to cut its energy intensity, but not its absolute emissions, and things like this that kind of, shows that they do want to keep increasing output, but, are still trying to please institutional shareholders who are keen to give them a green tag. And that's kind of been the way for a few years now of how we've seen them. Since 2020, when they both took big impairments on the slashing of forecasts of oil and gas prices, there's been a real change in how they operate. Any major corporation that cuts thousands or 10,000 jobs, in I think Shell's case, is going to be a different beast to what it was a few years ago. And they've done that at the same time as a massive change in energy prices. So I think in between 2020, when we obviously had one famous negative priced future in the US, and to now, it's chalk and cheese in terms of what's coming through. And as price takers, they obviously can't determine the market, but they've ended up as these leaner, more focused companies. And I guess I touched on Shell a bit there, but with BP, they'd made these promises around divestments and also changing the way they invest in new projects that would actually see a 40% reduction in oil and gas output by 2030. And so you have this, potentially more profitable leaner company where dividends have always been a focus, and you throw $100 oil prices and $6 to $10 Henry Hub and gas prices in the tens, if not more of euros, you're going to see some pretty extreme levels of cash flow. So kind of basically on the same way that they're quite different companies to what they were a few years ago, we've kind of I've taken a blank sheet and tried to really see what an investor is getting out of Shell and BP this year and beyond, given how much the energy market has changed recently.
Yeah, as you say, I mean, obviously things have, the world has changed this year, and there's been a big run up in those prices, and the question is really, what next, as it always is. But one thing you looked at was quite interesting was, Shell and BP in the global context, in the context of, the big US peers and how they compare valuation wise, which looks to be in their favour still.
Yeah, and I think this is something that's is once again a change on a few years ago, where Chevron and Exxon had slightly less investor pressure to buy renewable projects. To they've also been cutting operational emissions, but obviously it's with these companies, operational emissions are a tiny proportion of the emissions that they're linked to, really. But so they were kind of seen as the dirtier, I guess, oil and gas giants, or IOCs, international oil companies, as they're known. And now I think there's a much greater confidence within the industry and also within the investment community. And so Exxon and Chevron are more highly rated than BP and Shell. And for that, you look at the total shareholder return forecast from RBC for this year, 7% for Exxon and Chevron and 14% for BP and Shell. So there's been this almost switching in that valuation this year. So yeah, it's been an interesting swap, I think.
And what about those transition risks? Because obviously there are still plenty of investors, who won't hold oil companies, even this year when some mindsets might have changed. If you're an investor looking for the long term and you want to hold them with a view to, these companies are trying, or say they're trying to shift over. How far along are those plans? How advanced are they, and what do they kind of add or detract from?
Yeah, I think
the investment case.
I think the context, and there was actually an interview I did that didn't make it into the story, that looked at the assumptions that the energy majors are using for their climate scenarios. And these scenarios are basically how we, global emissions and inputs into that, and the temperature change that we end up with in 2100. And I think the one that BP is using to get to 1.5 degrees, a 1.5 degree increase, actually ends us on 1.8 degrees. And so there's things like that where even the numbers they're using are probably not perfect according to these researchers. But they're still oil and gas companies. And I think all this free cash flow, these buybacks and these dividends are coming from selling oil and gas at historically high prices. So I think anyone squeamish about holding these companies previously, either you can swallow that squeamishness and accept these massive yields, or not. I think there isn't really any change materially to their greenness. It's just that so the way BP talks about it is the energy trilemma, which includes energy affordability, availability, and I think moving into sustainability or more sustainable energies. And I think that triangle has switched a lot more to availability and affordability recently, which funnily enough doesn't actually help that much when you go to fossil fuels, because they're not affordable now. But I think those transition plans are could be supercharged by this environment. I mean, they obviously have a lot more cash, but that doesn't mean that the renewable energy opportunities are much more available. Even much more before this free cash flow scenario, BP was was putting huge amounts into, the Irish Sea offshore wind auction, where they broke records in a joint venture with the German utility. But they were already putting a lot of money into this space. This could potentially, charge that along a little bit. But they already had a lot of cash. This is, this cash is going to shareholders, and that, I think that's about it so far. Because I think they're quite wary of ramping up spending, of the short cycle. There's a little bit of increase in production from short cycle projects like US onshore, but yeah, I think they're quite wary of suddenly putting tens of billions more into any projects, really, just because they've done that in the past and they've stuffed it up for themselves.
And prices have fallen, and then you're back to square one from an operational perspective.
Yeah,
we shouldn't neglect, as you say, they are still oil and gas companies. To the average person, obviously they are symbolic of, in some ways, of profiteering and things like that. They're obviously making giant profits at a time of significant energy prices. So we can't really overlook the regulatory risk there. There is a windfall tax on North Sea operations already, which is admittedly a pretty small part of the overall picture there. I mean, are there bigger risks to the investment case purely because of the nature of what we're experiencing and about to experience over the next few months?
Well, I think one interesting, and this is medium term, so there won't be, I don't think, any massive government interventions that will change the investment proposition over the next year or so. But what I think on a purely economic basis, you see demand destruction from such high prices, and one of the scenario that I talk about in the piece is basically that assumption that Aramco might not find that much more supply. An Iran deal might happen, but there's no magic bullet to these energy prices, and therefore you get to the mid 2020s, and prices are still quite high, but adaptation happens, and you then also have governments reacting not so much to the energy companies, but aggressively pushing green policies and spending and shifting. So instead of there being a gradual reduction in oil demand, which is set to peak, I think, in a couple of years at about 110 million barrels a day, which is 10% higher than it was pre-COVID. It instead of being a gradual drawdown where BP and Shell get to maintain earnings and keep the party going for another decade, it becomes quite how would you say, quite aggressive, and things start happening in quite they're almost shocks to demand because of the rapid way things are changing. And I can't throw out any major technology changes or specific spending initiatives that would bring that on, but people who do this for a living have put it together a pretty credible case for that happening. And I think the world is not shocked by shocks anymore. Like, it's not maybe in 2020, very early 2020, if someone said quite dramatic things are going to change the energy markets multiple times over the next decade, you'd be like, yeah, right, whatever, mate. But now that seems pretty credible. Yeah,
I suppose in some ways, you just even just in terms of gas in Europe, in the next 6-12 months, from industry alone, you're starting to see the kind of substitution effects that you wouldn't have seen at all on a much larger scale for obvious reasons. So we'll see where we are, I suppose, in a year or two's time. Let's move on, because we are pushed for time as ever. Shell and BP, obviously pretty big dollar earners, and if you're a dollar earner right now, you're looking pretty good from a UK perspective, purely due to the latest fall in the value of sterling. Worst month since the referendum, I think August was. We are down to about 116, perhaps below that, against the dollar. We'll talk about some of the companies involved in a moment, but I suppose we maybe want to speculate or discuss the reasons for that renewed fall first. Monetary policy is one example. Mike, you've got some thoughts?
Yeah, I suppose we're down 14% so far this year, and the kind of gaping hole we have in the middle of UK leadership at the minute is clearly not not very good for the outlook. There are some fears over who comes in and whoever comes in, what sort of policies they try to set, and whether or not, I mean, Liz Truss has talked about maybe ending the independence of the Bank of England. So the forecasts are all pretty grim. The Capital Economics put out a note the other day saying that they expect, or that they think that the pound could fall as low as $1.05 by the middle of next year.
Yeah, it does seem to, I mean, forecasts aren't always correct, as we know, but people are very much anticipating further falls at the moment.
Yeah, it's the biggest. I mean, we're at the lowest level now since about 1984, or that would take it to the lowest level since 1984.
Yeah. Speaking of someone who's going to America in a few months, I'm looking on with a mild disappointment each week, but there we are. Mark, you were...
Oh, no, I was just going to point out as well that part of the reason that we aren't as faring quite as well as our European neighbours is the fact that GDP in this country is more closely linked to credit expansion. It's a much larger consumer sector, generally speaking, a lower level of savings as well. So that's a contributing factor that needs to be taken on board, just because of credit costs are increasing. And in fact, there was statistics out this month which suggest that households in the UK are now borrowing more simply to cover their sort of regular costs. So that's a quite a dismal. I mean, that was something that was waiting to happen for years, actually.
Mm. Well, it's quite interesting to me. The other thing we've had this month, obviously, is a big jump up in gilt yields, a big increase in expectations for where the Bank of England rate might be in a year's time or 6 months' time, which ordinarily might suggest the currency would strengthen, but really that's not been the case. I think the growth worries are paramount at the moment, and
I suppose those gilt yields are a risk-free rate, aren't they? And then every company that's borrowing has to borrow at higher levels, which isn't going to be great in terms of investment. And as Mark just said, if borrowing levels are the way they are for households, then the repayment of that debt's going to get a lot more expensive as well.
Yeah. Well, let's go into some of the implications. Mike, I know you'll be writing about this in next week's issue, so look out for that piece then. But just to touch on some of these points, I mean, there are obvious benefits for companies earning in dollars. I mean, if you're a listener, you have any overseas funds, for example, you're going to get obvious benefits just mechanically by the exchange rate, but also the companies themselves. There's the potential for some upside surprises there, putting a positive spin on it if you're earning quite a decent amount in dollars.
Yeah. I mean, there was a note by one of the brokers, Lee Braemar, sort of identifying which of the companies are maybe maybe the biggest beneficiaries, and you've got companies like Sage Group and WPP, the big advertising group, who are very prominent in the US, earn most of the revenue in the US. So obviously, when you transfer that back, then there's a great upside. But I think they were also pointing out that because these companies are UK listed, there's been maybe a bigger sell-off in their shares than is perhaps deserved.
Another interesting part of that note was looking at, we have seen, according to their calculations, dollar owners do better this year on a relative basis, even if, as you say, they have fallen. But they haven't done as well to the same extent that they used to. There's been what they say is surprising weakness in UK exporters, which we've seen some export figures. I'm not sure if that's down to new trading conditions with various countries or something else, but that is something to watch out for as well. The historical parallels aren't always replicated one-to-one. The other thing I suppose to say is, we'll be discussing this in more detail next week in print, but the obvious way to look at it is, the FTSE 100, the big multinational companies who inevitably have more revenues in dollars, but there are those elsewhere as well who are slightly less obvious, perhaps. And the other thing to look for, I think it's fair to say, is the costs, which is a much harder thing to do, to try and work out whose costs are actually in dollars. And, that's often something you don't know until you see the statement and they say, well, our costs have been are up even more than you thought they would be.
There's not that same breakdown in where you, there's usually the breakdown in the accounts of segmental revenue and where you earn your money, but not so much where you spend it.
I mean, to that end, I think in the Librum highlight a couple of companies which which don't break down the source of their input pricing and costs, but which have over the last 2 decades had quite a high correlation with the movement in the dollar. That's Burberry, Kinetic, and HomeServe, which they also note have done better than their peers and the sort of broader market in share price terms this year, implying the kind of opposite effect to the companies that Mike was talking about there, so Sage and WPP, i.e. that they may be overvalued and also their costs are rising at a faster pace than that investors are anticipating or are viewing. But, I suppose luxury goods is what, but in Burberry's case and defence in Kinetic's case have been two, relative shelters this year. So that might explain a little bit of that sentiment mismatch. Bit hard to say. I don't know. I mean, it's also difficult to say, isn't it, with currencies? I think, Mark, you always take the view in the past that things kind of come out in the wash, and that in a year's time, things may swing back. We try and take a slightly longer view.
Yeah, Dan's right to talk about sort of looking at this from a granular point of view as well, because I mean, if you go into resource companies or in fact airlines, anything like that, you have to take on board hedging arrangements too. So it's quite a complicated ask for investors.
Yeah, as you say, Alex, we shouldn't let the tail wag the dog and just start looking solely at this and maybe overlooking something of more fundamental importance. But nonetheless, it is the kind of thing you can see coming out in a few months' time in the results as a positive or negative boost, even if it is short-term and optical.
We can probably say that it would be good for distributions, at least.
Yeah, based on the proportion distributing in dollars, that should be some solace for investors if they still need it in a few months' time, which let's hope things are going a bit better by then, but we shall see. That brings us to the end of the show this week. Thank you for listening to us. Thank you to Mark, to Alex Hamer, to Alex Newman, and to Mike, and to John. And thank you once again to you for listening. We'll be back next week with another Companies and Markets show.